Hey everybody, it's PJ Patterson here on Friday evening, 22nd of May for a little market update. Um, crazy stuff going on in the markets. I'm going to get to that in a second. I'm also going to give you a little bit more of an insight today into the process and starting to drill into some data. I'm going to just share a few things with you, which I'll begin to share more of as I go forward. Just before I get into all that, though, I did want to quickly address some conversations I've been having with many of you around withdrawing from your super and withdrawing even from your self-managed super funds. If that is something that is, well, actually, let me rephrase that. Please only withdraw from your super or contemplate doing that if things are dire. Taking money out of super, you shouldn't really be viewing that as just because the government is offering it, that you should take it up. And I've had that conversation with a few people as well. Sometimes these things that they do, that they offer, that they want people to do, aren't good for you. And taking money out of your super is not a smart move because, of course, that takes money away from and out of a tax concessional environment that your money is growing in, right? So if you don't absolutely need to do that, please, my advice is don't do it. And of course, if you have any questions about that or would like to chat about it, by all means, you can give me a call to do that. So, hope everybody's doing well. We're gonna get a pass out here June 1st from Gladys. She said we're good to get back to gatherings of, I don't know, is it 10, maybe 20? I don't know. I've stopped following this thing. Honestly, guys, I go from my office to my home every day. As you all know, I bought an office up the road in Belrose. It's a 5-minute drive. So that is about the extent of my activity at the moment, from home to the office and back home again, maybe to Bunnings from time to time. Anyway, guys, there's a lot going on in the markets, and I am sure there is some FOMO amongst the client base. And you know what that looks like? And I'm really starting to dial myself into the market machinations, and you can almost see it and feel it, because I even feel it, right? I know I say to you guys, check emotion at the door and try to check emotions at the door. It's a very hard thing to do, especially, I'm trading my own account and doing all that stuff, and I see the ebbs and flows of the market. The good thing is that the process that I am now using, and I'll just share with you quickly, I get up at 5 a.m. every day to log into Interactive Brokers to check on the last hour of trading in the market and just see what's going on, see if there's any changes I need to make, anything that's happening. Usually, and here's a little insight into markets, usually the first hour and the last hour is where there's a lot of the activity that takes place in the day. So people want to jump on the market first thing, either sell, buy, whatever, position themselves for the day. There's usually a lull around lunchtime because people are obviously going on lunch and stuff. And then towards the end of the day, as news from other markets and other parts of the world start to filter in, and especially in the U.S. as the day goes on with anything that government officials are doing and that sort of thing, that affects the markets, and then traders and market participants will make positions, change positions, or whatever going into the close. And so that's why I get up at 5 a.m. every day. And I'll just share with you, I've got a little diary notebook. You can't really see what that is, but anyway. Every single day, I'm writing down across a number of assets that are important, their risk range, and their closing price and things of this nature, and using that as a guide for me to position trades and to just understand more about the market. So that's the commitment level that I've got to this whole game, which is the markets. And it's a commitment I've got to you in ensuring that I'm at the top of my game and doing and making the best decisions that I possibly can for our investments. So I use that term FOMO because this week and last week we had a rally in U.S. stock markets. And again, people are getting it's funny, right? People want there to be a recovery so bad. They want this to be a V-shaped recovery. And on any given day, market participants can sort of make that happen. They can tell the story, the narrative, and whatever, and they can try to make that happen. But, and I've used this terminology before, economic gravity always wins. Gravity, we know it, right? It's one of the laws of nature. it is a force that is very difficult to overcome. And there is economic gravity as well. And that is a force that is difficult to overcome. So the first thing I think I might do here is just share. I'm going to share a screen. This is a slide deck that is 150 slides long. It's from Hedgeye. They're the group that the data provider, the information provider that I get pretty much all my research and everything from, the process, everything else. Check them out. They're really cool. I pay big bucks to do this and get all this stuff. And of course, this process is the macroeconomic, global macro approach is in large part their approach. And I love it. I think it is so informed and it is so in depth, and it covers a lot of ground. But at the absolute base of all of this is mathematics and calculus. And I've got to say, of the 25 years that I have been trying to trade markets and play the game and all of that, I have never, ever come across such a logical, methodical, process-driven approach. And it has made my trading and my approach to markets so much clearer. And so I first, let me just say, I appreciate all of you who've been on this journey with me for a number of years now, and who are embracing and asking me questions about the quads and, having these conversations and are getting it, right? I'm really sensing through the conversations I'm having with many of you that you're totally getting it. And one of the cool things about this, and this isn't going to change, this is not a one-off, is we got out of the way of that moving bus of this market crash, which is ongoing, by the way. So let's kind of come back to FOMO for a second. Here's a map of the quads in the US and where we are right now in 2Q. So as you can see here on your screen, and you've heard me say the words deep quad 4, we are in deep quad 4. This is almost depression territory quad 4. And what is likely to occur over the next couple of quarters? I'm going to show you in a minute a slide on US GDP, which is just horrendous. Anyway, most likely what's going to occur is we're going to move across the bottom of this table or chart into quad 3. But it's going to be deep quad 3. And that's going to change the playbook. In some respects, it's going to change the playbook that we have on in terms of investments. Quad 3 is still a quad where you're still core positions of treasuries, gold. You can then add, if the volatility metrics are appropriate, you can start then adding in some equities like healthcare, utilities, REITs, things we did actually own about 7 months ago, but I had to jettison because volatility just went apeshit, right? So, and you guys know, if you've been watching these for any length of time, you know about the volatility stuff. So I'm not going to cover that off again. One of the things that's really powerful, I'm just going to put this full screen up for you. You probably can't read this too well, but anyway, one of the things that's so powerful about what Hedgeye does for me is they are, as data providers, they're passionate about, I'll just go back to this screen here. As data providers and as market people that are trying to beat the market, just like us, they backtest everything. They have the skill set, the tools, the knowledge, and the computing power to backtest the quadrant model and mapping to see how they perform in various situations. So for example, this slide over here on the right, let's see if I can here we go. Just blow this up a little bit and move over here. There we go. That's a bit better. So this is a table of the S&P 500 total return index. And across the bottom here is, first of all, the quads. What this shows you is the return expectation in the quad that you're in. And then the rest of this stuff is kind of like variables. So if we're going from quad 4 to quad 3, what happens? Quad 4 to quad 4, as an example. Here we go, quad 4 to 4, 4 to 3. And what this is giving us is an insight into the return that we could expect if you held the total return index, as an example. But this is the level of data and analysis that I am involved in with these guys. So this is where the edge is, right? This is how you get an edge in markets. This is what I'm going to say it, not probably 99% of financial advisors don't have any tools like this that they're using on a regular basis. And even fund managers out there, they would have similar models and tools that they'd be trying to use. But one of the things that they're inhibited by, which you're not and I'm not, is, say, for example, it's I'll just pick a fund. Let's just say it's a Beta Shares Australian, what's it called? It's the Australian 50s top 50 fund. I forget the exact name of it, but anyway, that fund holds the top 50 Australian companies, and so that's the only universe those guys can play in. So they don't have the ability. If as an example, the market is saying you can't own equities, you don't want to own Australia. You certainly don't want to own the banks and the resources companies and insurance companies and stuff that comprise the top 50 ASX. They don't have a choice, those guys that manage that fund, and ladies presumably as well. They have to own it. And their fund mandate says you got to be 90% invested. So they don't have a choice. They have to own that stuff. And if it's a bad asset class to own at that stage, or if it's a bad style factor, and I won't talk in depth about that today, but anyway, it's a term you'll start to hear me using more. But if it's a bad style factor to own, too bad, they have to do it. And that's why you see returns of funds drop badly in market crashes, because they actually have no choice but to own whatever it is their mandate says they have to own. But again, we don't have that same restriction or constriction, in that I can say to you guys, you know what, we're going into, let me just go back to this slide. We're going into quad, let's see if I can resize this here. Sorry, guys. 50% should work. Yep, we're going into quad 4. What's my playbook for quad 4? And on this, again, they have a playbook, and there's a little bit of a playbook here for you, but quad 4, here's the playbook. The greenish or lighter colored stuff is what you want to own, and the red is what you want to stay away from. Now, there are obviously things in each quad where there could be some small variance, and my job is to suss those out and make sure we don't get into the wrong thing for the quad. So as an example, as I've mentioned already, in quad 4, deep quad 4, I've said it before, the only thing you really want to own are U.S. Treasuries and U.S. dollar, and perhaps gold if the volatility of gold is low. A lot of this other stuff you wouldn't own if vol was really, really high, as it has been. So anyway, I wanted to explain a bit more about what's going on there, and how I'm doing what I'm doing, so that you can see quite clearly. And this is just an example of a lot of the data that gets forwarded out to me. But here's something that I did want to pause on, because again, I want to reiterate to everyone, and anybody that's got FOMO and is thinking, we've missed the bottom, or some other narrative that you might have going in your head. Today, right now, there's a lot of interesting stuff going on in the markets. Now, the markets probably tonight, this is the U.S. market I'm talking about, probably going to get slammed. The jobs number in the U.S. came out, and the headline was saying, it was great. The job, losses are only 2.4 million. But what they haven't added into that metric, and this is something that these guys at Hedgeye analyze and pick up on, is they haven't added in the additional 1 million jobs that are on this special program for the COVID-19 thing. It's kind of like our job seeker program here. It's called something different than the US, but there's like 1 million people, I think, on this program. You got to add that into the number. So when you do that, or maybe it's even 2 million. So when you do that, the jobless number is actually worse than it was last report, which was a week ago. So we continue, as what I'm really trying to say here is, in the US, we continue to have deteriorating economic data and conditions. So like I say, everybody is keen to have this V-shaped recovery, and I'm going to keep saying it until it isn't, until we're done with this recession, this depression. We're not going to have that. We're going to have a W, if anything. It's going to go up, and we're kind of in the first leg of the W, right? We're in the first V of the W. We're headed back down, and we may be headed back down in the next couple of weeks. But here is the GDP forecasts for the next 3 quarters. So we've got this quarter. Everyone knows the GDP number is going to be horrendous. Hedgeye is forecasting it to be down 10%. There's some other estimates that are a little bit less than that, but nevertheless, it's going to be a bad number. They'll try to paint it as not so bad and gloomy, but I think when the real number comes out, unless it's only like a -2%, which there's virtually zero chance of that happening, we're going to see the market probably wake up and go, oh my gosh, like we're really in for it here. The next quarter, though, we should see the GDP number not be as bad, and off the back of that, we might see, the next part of that V happen. Then we've got two further quarters, quarter four, but I'll get my words out today. Quarter four of this year, 2020, likely that GDP will take another dip, and then we should again start to see some sort of recovery beginning in not until the first quarter of 2021. So obviously all this data can change. And the cool thing about being data dependent, and this is where hopefully you're starting to really, you're starting to hear me on this, is every single day. The reason I get up, one of the reasons I get up at 5 a.m. every day is to look at the data because I reserve the right as your advisor to make changes as the data changes. I'm not married to any sort of narrative or any stupid story that you often hear put out there by various advisors, financial media, and whatever. They're like, oh, this should be happening, or we don't understand why this is happening because it shouldn't be this way. I don't care what should be happening. I want to play, and for any of you sports people out there, if you've had coaches talk to you about your sport, if it's a ball sport anyway, keep your eye on the ball, and you play the ball, or you play the thing that's in front of you. That's the game you're playing. And so the data, the stuff that we're getting, that I'm getting every day from these guys in particular, but from other sources as well, I am playing the game that's in front of me and making changes and decisions based on that. So hopefully you understand and can begin to sort of get a respect for that. That's what I'm doing, right? And that's why as well you're seeing from time to time you might see a flurry of activity from the Interactive Brokers platform, where you'll get some reports and you'll get some trade stuff. And you might be wondering, oh, why am I getting these reports or whatever? It's because I'm making changes inside of your individual portfolios. And of course, if you ever have any questions about any of that, I want you to contact me. I want you to email me, and I want you to have that engagement, or at least know that you can have that engagement with me. One of the reasons I do these market updates and I tell you this stuff is so that hopefully you go, I understand and I get it, and I know that PJ is making changes based on all of this stuff that he's doing. So one other thing I think I'll just touch on, because it is 6:35, and I think I've got some Japanese waiting for me at home. So I'm going to get on home and get a fire going and a nice glass of wine and get stuck into some Japanese. Anyway, I'm getting myself hungry even talking about it. This is an inflation forecast, and right now, inflation is pretty benign. Like this is like if you were to draw a line, like a sine curve, right? One of the first slides here, I'm just going back to it, was a sine curve. And I've shown you this slide before. This is the business cycle, ladies and gents. This is an acceleration, or even if you want to say sort of a recovery, a growth phase even. This is a peak. I mean, duh, right? We've all seen a curve. This is a peak. This is our decline, and this is our depression and recession, and then our recovery. So, we are, and if you just were to take this part of the curve right here, and you were to overlay that, heck, let's, where'd my GDP thing go? Sorry. This one, the bars aren't really high enough, but if you were to overlay this over GDP, look at that, that's a sine curve, right? It's going up and over. The peak was right here, 3.2% GDP back in 2Q of 18. And then it just sort of declined from there. And whammo, here we are in the bottom part of the sine curve. This is the bottom part of the sine curve. This is the depression or recession. So when you start to get that and you put that into context, you're like, damn, I'm getting it, right? I know now. here's what I know now, that in here we were in, quads 1 and 2, right? We went into quad 3 over in here, and then whammo, we're in quad 4 probably for a couple of quarters. And there's a playbook that we put on for that. So I'm not gonna dwell on that too much. But again, here's that sine curve, right? Here is the curve, and here's your peak. Here's your top apex of that curve, and going down. Now, obviously, it doesn't fit exactly, because we're not going to see negative inflation, but you always have some inflation. But if you were to, invert that or something, you would see that the sine curve would be going down, and inflation is beginning to rise. As you can see, this is what this is all about. Why I wanted to dwell on it, because as inflation rises, guess what asset class is going to do well? Yeah, gold. If any of you said gold, well done. That's one of them. Commodities broadly will do well. We'll see that reflation of commodity, or we'll see commodity price inflation. Funnily enough, energy is something you want to own in quad 3. Now, we all know that oil has been absolutely, bitch slapped in the last little while. And actually, here's an interesting slide I'll quickly share with you. I'm just going to go on a little bit of a journey here. So if you want to cut it off now, go right ahead. But if you're interested in this stuff, as you can clearly tell I am, I'm going to spend another minute or two on this, and then I'll wrap up. But this is all of the data points that these guys track. There's an algorithm or a model that they have. Each of these things are ranked in that model, and they get us to, ultimately, this is how we get to what quad are we in. Now, you've probably already worked out green is good, red is bad, and there's a lot of red right now. And the reason there's blanks here is because these are data points that have not been filled in yet. So because it might be only reported once a month, or maybe even once a quarter, that sort of thing. Usually they're reported once a month, I would imagine. Anyway, what else can I just share with you? There's so much data. It's just incredible. This is another thing that I've shown many of you before as well, which is the quad map. And I don't want you to, one of the first things I've noticed that a lot of Hedgeye people that follow Hedgeye do is they just immediately go, oh, look at the third quarter, and look at, we're in 2s and 1s and everything. Well, that is, you just need to ignore all of this stuff out here, because we just don't have, just going back to this chart here, this table, we just don't have the data yet. So that was a projection based on the same time in previous years, and kind of what they are effectively forecasting, but we know that it's not right, because we just don't have the data visibility. So while there's a number there, the probability of that occurring is quite low. And so that'll change as we get more data. So if I went back even 5 months, 3, 4, 5 months, and showed you a chart of this, there would not be this red. Basically, the entire thing is red, except for China, which is the one which is kind of funny because it's probably made up, and that's BS. But anyway, the whole world is in quad 4. Now, that wouldn't have been the case if I showed you this table, maybe 5 months ago or something like that. Anyway, so I don't really think there's much else I want to show you there on that one. So to wrap up, let me wrap up, because it is Friday and I got some food waiting for me at home. Here's where we're at right now. We are in, again, we're in that retracement of the big sell-off that we had back in March. We're still in a bear market, and the playbook that we've got on right now, which is heavy in cash, treasuries, and some gold, is going to be the playbook that I stick with for the foreseeable future. Now, I've sold down some treasury positions just to take a bit of profits, which I've done, and I might put that position back on soon. But I'm actually looking to move more into gold and some of the gold miners and things like that, because I think as inflation begins to become an issue, we're going to see a bull market breakout in gold and in the gold miners. So I'm going to want us positioned there, and really that's about it. So please engage me with any questions that you've got. A lot of these things, it takes a while to get used to maybe a new way of thinking, or a new pattern, or any of that sort of thing, if you want to put it that way. It takes a while to get used to that stuff. And so I hope that you're listening to what I'm sharing. You're not studying it per se, but you are absorbing some of this stuff, because I absolutely believe this. We will benefit greatly by having this process and this overlay. such that my plan and my desire and hope is that I will generate many basis points, so many percentages of alpha, which is performance over and above just the normal market performance for you because of this process. And it'll take the form of probably being a little early. So as we go into what is known as a phase transition, and that phase transition will be going from, say, quad 4 to quad 3, we enter a phase transition. There'll be a bit of volatility, there'll be a bit of uncertainty, but the market, the things that are the markets, the data the market is giving us will be saying, yep, we're moving into this new phase. We'll be a little bit early. Because remember, retail investors and even a lot of professionals will set the tone. Retail investors catch up. We're actually trying to have that edge of the top professional investors who are positioning themselves correctly and understand what's going on in the market, so that by the time everybody else catches up, we are already well positioned for it and have already made a lot of money in it, and we're catching that cream of the move in whatever quad we're in, whatever investments we're in. So I think I'll wrap it up by simply saying, if you have any questions about any of this stuff, please don't hesitate to ask. I hope you're as excited as I am, even at 6:40 on a Friday night, about the markets. I will be up at 5 a.m. tomorrow morning to check out the last hour of trading. And guys, I hope everyone's excited about getting some freedom back. And probably in my next market update, or maybe next week, I'll talk a little bit more about COVID and some other things that I've been learning about that. But please do have a happy and safe weekend, even though the weather is crap. And guys, take it easy. I'll talk to you soon. Bye-bye.